Hello everybody and welcome back. In this video we will talk about Amazon. They just reported earnings. So what we will do in this video is very simple. I will comment on the latest earnings report because you have some adjustments to make to really understand the earnings power of Amazon. Some elements that very few people are talking about. So I think it will be pretty interesting. We'll go through the report. You will have my opinion if this was a good quarter or not. Apparently people like this quarter because the growth in AWS is back. So in pre-market the stock is up plus 11%, plus 12%. So that will be for the first part of the video. And for the second part we will listen together to the earnings call and I will comment on what they have to say, because there are a few points you want to double check when it comes to Amazon. If you are a shareholder, you want to listen to the call. So we will do this together. And full disclosure, I own Amazon. This is roughly 9 or 10% of my portfolio. So I've been a shareholder for a while now. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, thanks to Amazon also. So I want to start this video with the report, because people are cheering up, but not everything is important in the report. This is always the case. Amazon is such a big conglomerate. They own a lot of things. First of all, let me say it's a very good report when it comes to growth. If you look at the net sales have grown by 13%. This is very good, very healthy. You have a strong reacceleration of growth for Amazon. What is next is the operating income. You have an operating income that is flat, okay? And you have this element, this paragraph. The third quarter 2025 operating income includes two special charges. $2 billion related to a legal settlement with the Federal Trade Commission for anti-competitive measures for Amazon Prime users that were unwillingly subscribed to Prime and they could not cancel their membership. So because it's not really ethical to do this, they had to pay a fine of $2.5 billion. So this was a one-off event, a one-off expense. And the second one-off expense is $2 billion in estimated severance costs, primarily related to planned role eliminations. You are probably aware that now Amazon is going full on robotics, and they are cutting staff. They are firing people, so it will improve the margins for next year. For the moment, you have to pay $2 billion for severance costs. So without these charges, Amazon says operating income would have been $21.7 billion. So the operating income is not flat, but it is growing. And you can calculate the growth rate of the operating income. 21.7 divided by 21.7 divided by, what was the operating income last year? 17.4. You have a growth rate of operating income for the core operations of the business of 24%, 25%. Very healthy, very, very healthy. Amazon is growing the operating income by 24% per year. This is wonderful. Let me continue on the report. You have international expansion, international segment. Everything is growing double digits. The AWS segment is growing 20% per year. AWS was the most important segment for the second quarter of 2025. And once again, this quarter, it is the most important segment. This is what investors are focused on. Let me continue. Net income increased to $21 billion, okay, compared to $15 billion. So you have a nice growth rate when it comes to the net income. You have 21.2 divided by 15.3. That's, 0.2 divided by 15.3. You have a growth rate in net income of 38%. And I made a video about Google for the exact same problem, meaning Amazon is cheating. Amazon is cheating, Google is cheating, because in their portfolio, in their balance sheet, they own companies. They are an owner of what, 14% of Anthropic. Amazon owns a substantial ownership in Anthropic. And you have this, what I highlighted in red here. Third quarter 2025 net income includes pre-tax gains of $9 billion included in non-operating income from our investment in Anthropic, PBC, which means you had $9 billion that were added to the net income. This acts as a boost. Maybe you need to adjust this. Maybe now we are in a bull market. The value of Anthropic is going up. So accounting wise, you have to account this for additional profit. Well, when times will be bad, when you will have a recession, this investment will go down in value. So maybe you will need to adjust this number to really see the core operations of the business. In this YouTube channel, we are talking about businesses. Stocks represent partial ownership in public businesses. So we want to be in this mindset of an owner, right? And this is not really good. So if you only look at the net income growth, you can be cheering up plus 38% growth rate. It's false because it's too turbocharged by this investment in Anthropic, right? So you want to adjust. So we'll talk about the adjustment later. What is the real growth rate when it comes to net income for Amazon, okay? By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Next thing, everything is normal. The capex is high, the free cash flow is low, this is normal. And now what the management is saying is very smart. We continue to see strong momentum and growth across Amazon as AI drives meaningful improvement in every corner of our business, said Andy Jassy, President and CEO of Amazon. If you remember correctly, in the second quarter of 2025, Amazon was criticized because they did not improve in the AI world. Wall Street analysts expected better from Amazon. They expected better growth rates, better implementation in AI. Now, for the first sentence, they are talking about growth and AI. Second sentence, AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20% year on year. And this is true. Look at this. This is the growth rate of AWS. I'm on Fiscal AI right now looking at the charts. And for the AWS revenue percentage change, this is it. This is the blue line, the growth rate of AWS. You see that in 2021, AWS was growing by 40% per year. And then it declined to 12% per year. In 2024, we reached 17, 18, 19% per year. And now we are back to 20% per year. So he is right. Now we are at 20% growth rate for AWS. And the last time we had 20% was in the Q4 of 2022. So he is right. And this is the second sentence from Andy Jassy. Again, clear execution. The management knows how to please shareholders. It's their priority to come back to growth. We continue to see strong demand in AI and core infrastructure, and we've been focused on accelerating capacity, adding more than 3.8 gigawatts in the past 12 months. Clear bullishness to please investors, because in the last quarter, these were the problems people highlighted. Well, for the first paragraph, the first sentences, Andy Jassy is addressing all these problems, saying, guys, we are on it, we are working properly, and we are back to growth, AI, growth. So he is saying exactly what investors want to hear, which is bullish for you as a shareholder, for us as shareholders. In stores, we don't care about this. Okay, the e-commerce segment, we don't care about this. It's all about margins improvement. I will just skip all these parts because Amazon is doing everything and I don't want the video to be 3 hours long. I just want to spend a few minutes on the report and then we'll look at the earnings call together. This is, I believe, how I can give the maximum value to you with this video. Some highlights that I've not seen anyone talk on YouTube about is if you look at the cash flow statement from this quarter, the SBC is going down. Stock-based compensation, look at this. Let me zoom in. Stock-based compensation, come on. Stock-based compensation, this is this line. In 2024, the SBC, so the stock options, the free shares that the company is giving to employees, it was $5 billion, 5.3. And now, as the business is growing 20% per year in some segments, 13% per year in some segments, the SBC is down less than $4 billion. So the company wants to be efficient. Okay, this is good. This is pretty good and what you want to see. Next point, obviously you have a strong acceleration in CapEx. This is this line in green. Purchases of property and equipment from $22 billion to $35 billion. Huge CapEx expansion. And they will continue. Okay, next point. Okay, we have a couple of adjustments to make now. Fair enough. This is your income statement. And I've seen no one on Twitter talk about this. So here is how I will add some value to you. Your income statement looks like this. Let me zoom in so you see very well. For the third quarter of 2025, as I told you at the beginning of this video, you have two adjustments to make. In third quarter, operating income includes two special expenses, two special charges, $2.5 billion and $1.8 billion because they fired people and because they were having a fine from the FTC. Okay, what is your real operating income if you take into account this? So the real is 21.7. Okay, so if you really want to understand the core operations of Amazon, how the real core business is doing without taking into account all these fines or the Anthropic investments, you have to make these adjustments. So it's as if the operating income here in green was not $17 billion, but $21 billion. So maybe I can write, I want you to understand this because this is quite important. 21.7, right? Here, 21.7. This is our new line. This is your new operating income. And you have this investment here in Anthropic from their portfolio of $10 billion. This is what we said at the beginning of the video. If I scroll down, the third quarter net income includes a gain of $9.5 billion. So you have to account for this. You have to account for this and adjust. So let's adjust. We will just remove 9.5. So 10.2 minus 9.5, we have something else. So we put 0.7 here. Actually, it would be more like 700. Yes. And this would be 21,700. Okay, so this is your operating income. Fair enough. So the real income before income taxes is not $28 billion. It's 21,700 plus 1100 minus 538 plus, let's say, 700. The real operating income before tax, the real income before taxes, sorry, is not 28. It's actually 22.9 this, or let's say 23,000. It will be easier. Anyway, you will get my point. So that's a clear difference, right? $5 billion that are completely fake. The real data needs to be adjusted and the growth rate is not that sexy. So if you look at the growth rate of this, you don't have the same growth rate before and after. Okay, now we have to calculate the new tax rate. You have to change this, okay? What was the tax rate of Amazon for this quarter? You can go to Fiscal AI, you go to income statement, you scroll down, effective tax rate. This is what we have on a quarterly basis. So the tax rate is 24%. 24.5. Okay. What is 24.5%, 0.20, or actually I can show you here, 0.24.5, 5, it will work, 5.3, times 23,000, right? 23,000 for the new adjusted number. You have this 5,600, 5,600, 5,600, 5,600. Okay, so again, this needs to be adjusted. Come on, don't show me this message again. This needs to be adjusted. I hope you understand the exercise, and so you can do the same at home, because plenty of companies need adjustment. All the companies that have an equity portfolio, or they just adjust for metrics, they are just boosting their earnings, fake earnings. So what is the new net income? You have 23,000 minus, minus this, roughly speaking, right? I don't care about decimals and real data. I'm just focused on rough numbers. 17,400. 17,400. Okay, now you can see properly. This is your real net income. This is your real net income. We have finished, which means the growth rate for the net income in the past, it was 21 divided by this. The growth rate in net income in the past was 38%. We have seen this before. I wanted to double check. You don't have a growth rate of 38%, but actually the real operational growth rate is 13.5%. 13%, not 38%. So in the report, people are cheering up on Twitter. People are cheering up, saying the business model is the best. You have a wonderful report. Revenue is going up by 13%. Margins are roughly stable. So the net income is really going up by 13% per year. You have 13.51% growth rate year on year. Nothing really crazy, nothing really bad. This is the real growth rate of net income. And the company is doing a tiny buyback. So the earnings per share are growing the same. Okay, so Amazon is not growing 30%. Amazon is really growing 13% per year. Okay, I wanted to start this video doing a couple of adjustments so you really understand the earnings power from Amazon. What did I write here? Also, we need to adjust the unrealized gains. Let's remove 10 billion. We need to adjust the provision for taxes. Yeah, I mean, we've done the exercise live, all the adjustments, so you understand. Let me continue with the report and then we'll go to the core. Do I have things to say here? Yes, obviously the big important feature from this report is the AWS growth, growing 20%. This is quite phenomenal. Let me continue here. And you have margins from AWS that are improving. If you look at this big table, it shows you the growth rate and the margins for all the quarters, 1, 2, 3, 4, 5, 6 quarters. And the margins for AWS in green here, 35%, 38%, 37%, 39%. Last quarter, the growth rate of AWS was disappointing, not growing that much, 17%. But the margins went down to 33%. Now margins are back up. So for AWS, most important segment again, margins are up, growth rate is up, reacceleration, and they say you have immense demand in the future. So I believe Amazon has issued a very good quarter, very good numbers so far. You need a couple of adjustments, but still Amazon is in no danger. Now 2025 is a year with tariffs. So with all these tariffs environment, Amazon is still delivering double-digit growth, which is really good. And AWS is growing, and they have a lot of demand in AWS. By the way, you can continue to cheat for your portfolio in Anthropic, because Anthropic is one of their biggest clients. So you can just continue for the next few years to have a collaboration with Anthropic. Anthropic buys more for AWS, and the value of Anthropic goes up because they have more revenue, more profits. And because the value of Anthropic goes up, Amazon benefits. So it's a virtuous circle, and this flywheel can continue for a couple of years. Okay, next on the list, we've talked about this, we've talked about AWS. I want to go and see the transcript, the earnings call, and together we will listen to the earnings call, and I will add some comments along the way. Normally the audio should be working properly. I'm doing something special for this video, so maybe the audio is strange, but I'm trying stuff. Anyway, let me start the call. The call is 1 hour long, 50 minutes long. I will just put 1.25 speed. Take a cup of coffee, take a cup of tea, take a glass of water, and enjoy the show.
Joining us today to answer your questions is Andy Jassy, our CEO, and Brian Olsavsky, our CFO. Our guidance assumes, among other things, that we don't...
Thanks, Dave. We saw strong growth across our business in Q3, and we're reporting $180.2 billion in revenue, up 12% year over year, excluding the impact from foreign exchange rates. Operating income was $17.4 billion, but would have been over $21 billion if not for two special Q3 expenses, $2.5 billion for an FTC settlement and $1.8 billion for estimated severance costs. Trailing 12-month free cash flow was $14.8 billion.
A couple of points we want to know from this report is why, first, why did they fire people? For some reasons, to save costs, or just because they are complacent, or just performance metrics, or just because this is a big company that has a lot of bureaucracy, so maybe you want to cut some staff because they hired too much, and also you want more information about AWS. These are the big takeaways: the big demand, the backlog, and the market share in the cloud segment, and also how they will implement AI everywhere, and robotics. A couple of points. We want to know a couple of things during this call. We will see.
I'll start with AWS. AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20.2% year over year, our largest growth rate in 11 quarters. It's worth remembering that year-over-year percentage growth is a relative term. It's very different having 20% year-over-year growth on a $132 billion annualized run. Backlog grew to $200 billion. It's very different having 20% year-over-year growth on a $132 billion annualized run rate than to have a higher percentage growth rate on a meaningfully smaller annual revenue, which is the case with our competitors.
Very true. For Azure and Google Cloud, they are smaller. So it's difficult to grow 20% per year if you are bigger. So yeah. Congrats to them.
Backlog grew to $200 billion by Q3 quarter end and doesn't include several unannounced new deals in October, which together are more than our total deal volume for all of Q3. AWS is gaining momentum. Customers want to be running their core and AI workloads in AWS, given its stronger functionality, security, and operational performance. And the scale I see in front of us gives me significant confidence in what lies ahead. I'll share a little more detail on why. It starts with AWS having much broader infrastructure functionality. Startups, enterprises, and governments want to move their production workloads to the place that has the broadest and deepest array of capabilities. AWS has more services and deeper features within those services than anybody else and continues to innovate at a rapid clip. These are key building blocks for anything that customers want to create, and they're a big part of why Gartner has named AWS leader in its Strategic Cloud Platform Services Magic Quadrant for 15 consecutive years. We're bringing the same building block approach to AI. SageMaker makes it much simpler for companies to build and deploy their own foundation models. Bedrock gives customers leading selection of foundation models and superior price performance to deploy inference into their next generation applications.
Be careful, be careful. Andy Jassy, the CEO of Amazon, was accused of talking too much in a boring way last quarter. And if you go too technical in your earnings call, people don't really understand what you mean. And other companies are much more excited when it comes to AI. So a reason why Amazon drop is dragging this year because of the performance, slowdown in AWS, but also tone of the management team. People in the stock market expect great things coming from AI. The stock market is high. Let's not kid ourselves. Everything is expensive. So because it's expensive, the expectations for growth are high. So you want tech companies to make big promises, to not aim for the stars, but you want them to be very optimistic when it comes to AI applications. And last quarter, the tone of the management from Amazon was not so bullish. It was technical and quite neutral. So yeah, you want more bullishness. Maybe they were bullish. This is the reason why the stock is up so much. We will see.
A lot of the future value companies will get from AI will be in the form of agents. AWS is heavily investing in this area and well positioned to be a leader. Companies will both create their own agents and use agents from other companies. For those building their own, it's been harder to build than it should be. It's why we launched Strands, to make it much easier to create agents from any foundation model that builders desire. For companies who successfully built agents, they've hesitated putting them into production because they've lacked secure, scalable runtime services or memory or observability built specifically for agents. It's why we launched Agent Core, a set of infrastructure building blocks that allow builders to deploy secure, scalable agents. Ericsson used Agent Core to deliver AI agents across their workforce. Sony used it to build an agentic AI platform with enterprise-level security, observability, and scalability. And Cohere Health is using Agent Core to deploy agents that will reduce medical review times by up to 30 to 40%. Agent Core's SDK has already been downloaded over 1 million times, and our builders are excited about it. It's an enabler. Companies will also use others' agents, and AWS continues to build many of the agents we believe builders will use in the future. For coding, we've recently opened up our agentic coding IDE called Kiro. More than 100,000 developers jumped into Kiro in just the first few days of preview, and that number has more than doubled since. It's processed trillions of tokens thus far, weekly actives are growing fast, and developers love its unique spec and tool calling capabilities. For migration,
This is very interesting, but this is not what investors want to hear actually. So it's about their business perspective. They are talking about the applications of AI everywhere, which is good as a company. But you are watching this video because you want to know more about the stock, right? And what moves the stock. I'm telling you, all these things are not what is important. This is not what is important for Amazon. This will not move the stock. Kiro, this is not what is really important for Amazon. What is important is what I told you before. AWS, robotics, firing of other people.
and transformation, we offer an agent called Transform. Year to date, customers have already used it to save 700,000 hours of manual effort, the equivalent of 335 developer years of work. For example, Thomson Reuters used it to transform 1.5 million lines of code per month, moving from Windows to open source alternatives and completing tasks 4 times faster than with other migration tools. Customers have also already used Transform to analyze nearly 1 billion lines of mainframe code as they move mainframe applications to the cloud. For business customers, we've recently launched QuickSweep to bring a consumer AI-like experience to work, making it easy to find insights, conduct deep research, automate tasks, visualize data, and take actions. We've already seen users turn months-long projects into days, get 80% plus time savings on complex tasks, and realize 90% plus cost savings. And for contact centers, we offer Amazon Connect, which creates a more personalized and efficient experience for contact center agents, managers, and their customers. Connect has recently crested $1 billion annualized revenue run rate, with 12 billion minutes of customer interactions being handled by AI in the last year, and is being used by large enterprises like Capital One, Toyota, American Airlines, and Ryanair. These are real practical results for customers, and there are many more examples like them. Because of its advantage capabilities, security, operational performance, and customer focus, AWS continues to earn most of the big enterprise and government transformations to the cloud.
Good.
As a result, AWS is where the preponderance of companies' data and workloads reside, and part of why most companies want to run AI in AWS.
By the way, I wonder if they will talk about the outage, about the problems they've had for 1 day or 2 days for AWS. Half of the world shut down. So maybe they will talk about this.
To enable customers to do so, we need to have the requisite capacity, and we've been focused on accelerating capacity the last several months, adding more than 3.8 gigawatts of power in the past 12 months, more than any other cloud provider. To put that into perspective, we're now double the power capacity that AWS was in 2022, and we're on track to double again by 2027. In the last quarter of this year alone, we expect to add at least another 1 gigawatt of power. This capacity consists of power, data center, and chips, primarily our custom silicon Trainium and NVIDIA. We've recently brought Project Rainier online, our massive AI compute cluster spanning multiple U.S. data centers and containing nearly 500,000 of our Trainium 2 chips. Anthropic is using it now to build and deploy its industry-leading AI model, Claude, which we expect to be on more than 1 million Trainium 2 chips by year-end. Trainium 2 continues to see strong adoption, is fully subscribed, and is now a multi-billion-dollar business that grew 150% quarter over quarter. Today, Trainium is being used by a small number of very large customers, but we expect to accommodate more customers starting with Trainium 3. We're building Bedrock to be the biggest inference engine in the world, and in the long run, believe Bedrock will be as big a business for AWS as EC2. And the majority of token usage in Amazon Bedrock is already running on Trainium. We're also continuing to work closely with chip partners like NVIDIA, with whom we continue to order very significant amounts, as well as with AMD and Intel. These are very important partners with whom we expect to keep growing our relationships over time. You're going to see us continue to be very aggressive investing in capacity because we see the demand. As fast as we're adding capacity right now, we're monetizing it. It's still quite early.
This is good. As fast as we are adding capacity right now, we are monetizing it. People want to see huge backlog for AWS, and they want to see incremental revenue.
And represents an unusual opportunity for customers in AWS.
Okay.
I'll now turn to stores, where the team continues to deliver and innovate for customers across our key priorities: selection, low prices, and convenience, particularly fast delivery. We're offering 14% more selection since last quarter from popular brands like the North Face and Charlotte Tilbury, and we've added hundreds of thousands of items from popular brands this year.
Let me speed that up. This is less important.
Everyday Essentials continues to grow quickly, and year-to-date is growing nearly twice as fast as the rest of the business. We continue to make it easier for customers to order low-priced perishable groceries from Amazon, and customers in more than 1,000 cities and towns now can shop fresh groceries alongside millions of Amazon.com products with free same-day delivery. This is a game-changer for customers who can now order milk alongside electronics, check out with one cart, and have everything delivered to their doorstep within hours. The team also invented a new add-to-delivery button that lets customers add items to previously scheduled orders, and it's been used more than 80 million times since launch, and it just launched. It's an example of one of those seemingly simple but powerful innovations that make customers' lives easier. We remain committed to staying sharp on price and meeting or beating prices of other major retailers. In July, we had our biggest Prime Day event ever, with customers saving billions of dollars across more than 35 categories. We continue to break records on speed. We're on track to deliver at our fastest speeds ever for Prime members globally once again this year, and we've started rolling out 3-hour delivery in select U.S. cities. We're also continuing to invest in infrastructure to speed up rural deliveries and serve more customers in more communities. That includes committing over $4 billion to expand our rural delivery network across the U.S. These are small towns where people want fast delivery, but where other companies have been backing out and reducing service. In contrast, we've already increased the number of rural communities with access to our same-day and next-day delivery by 60%, reaching roughly half of the total communities we plan to expand to by the end of the year. The stores team is also innovating rapidly with AI. For example, Rufus, our AI-powered shopping assistant, has had 250 million active customers this year, with monthly users up 140% year over year, interactions up 210% year over year, and customers using Rufus during a shopping trip being 60% more likely to complete a purchase.
This is good. This is good. You want to implement AI everywhere, including the shopping experience. This is quite important.
Rufus is on track to deliver over $10 billion in incremental annualized sales.
Good.
Here are the highlights. Our generative AI-powered audio feature that combines product summaries and reviews to make shopping easier has expanded from hundreds of products at launch to millions of products, and millions of customers have used it, streaming almost 3 million minutes. And Amazon Lens, an AI-powered visual search tool that lets customers find products with their phone's camera, a screenshot, or a barcode, now includes Lens Live, which instantly scans products and shows real-time matches in a swipeable carousel. Tens of millions of customers are using Amazon Lens each month. Moving on to Amazon Ads, we're pleased with the continued strong growth, generating 17.
By the way, we have not talked about Amazon Ads, but the ad segment, the advertising segment from Amazon is growing and reaccelerating, which is very bullish for the company as a whole. If you look at the growth rate for advertising quarterly, this is what you have. So last year, the growth rate was 18% per year, 17% per year. Now reaccelerating 23% per year. So the advertising segment, very high margin segment for Amazon, is growing 23% per year. Very bullish and reaccelerating.
$0.6 billion of revenue in the quarter and growing 22% year over year. We see strength across our broad portfolio of full funnel advertising offerings that helps advertisers reach an average ad-supported audience of more than 300 million in the U.S. alone. We also continue to be excited about our demand-side platform, Amazon DSP, which lets advertisers plan, activate, and measure full funnel investments. Last quarter, I mentioned our partnership with Roku, and we built on that with a partnership with Netflix, providing advertisers using Amazon DSP with direct access to Netflix's premium ad inventory. We announced integrations with Spotify and SiriusXM. With Spotify, we provide advertisers with direct programmatic access to a global audience of more than 400 million monthly ad-supported listeners. And with SiriusXM, brands can reach 160 million.
Honestly, this is not really important. All these paragraphs are not really important. So this is why I'm putting 1.5 speed.
Monthly digital listeners across services like Pandora and SoundCloud. And we're excited about the advertising opportunity around Prime Video Live Sports. Live sports got a lot of interest from advertisers in upfront negotiations for 2025-26, and we exceeded our own expectations for upfront commitments with significant growth across the board. Finally, we're continuing to innovate for advertisers with AI. For example, in September,
Yes, please use AI, the AI word, in every paragraph. This is what we want to see.
we announced an agentic AI tool in Creative Studio that plans and executes the entire creative process in a matter of hours instead of weeks. We're also inventing and seeing strong momentum in several other areas, and I'll mention just a few. In Prime Video Live Sports, NBA on Prime tipped off last week, and our opening night doubleheader averaged 1.25 million viewers in the U.S., a double-digit increase over last season on cable. You'll see us bring the same constant innovation here that we brought to our NFL broadcasts. We're adding golf with the Masters in 2026 and a new skins competition with the PGA Tour on Black Friday this year. And we've added Peacock and Fox One to Prime Video's add-on subscription offering of over 100 channels in the U.S. We continue to be energized by the response to Alexa Plus. Compared to what we call the classic Alexa experience, Alexa Plus customers are talking to Alexa 2 times more. Those interactions are much longer and they're covering a broader range of topics.
Yeah, seems like Alexa Plus is not a winning investment for Amazon. They've been talking about Alexa for so many years. I don't see the incremental earnings from this investment. They are talking a lot about Alexa and the way you can communicate with this agent, but so far you have seen no real results accounting wise.
They're using Alexa Plus on Fire TV at 2.5 times the rate of Classic, using natural conversation to discover audio content 4 times more, engaging with photos 4 times more, and customers are completing 4 times more shopping conversations that end in a purchase. We've expanded the number of Project Kuiper satellites in space to more than 150 and delivered over 1 gigabit per second speeds in tests with our enterprise-grade customer terminal, the first commercial phased array we know of to clear that threshold. Finally, Zoox robotaxis are available to riders in Las Vegas, and we've announced Washington, D.C. as the 8th testing location. We're excited for these to continue rolling out to more riders.
Okay.
Q4 is one of our busiest and most energizing times of the year, and we're excited about the continued demand for AWS, the innovations we'll announce at reInvent in December, the positive customer response to our AI-powered experiences, all the gifts we'll be delivering throughout the holiday season, and a lot more. Thanks in advance to our teammates around the world who are gearing up to deliver for customers once again.
Something also that I want to point out is the advertising revenue. Normally, I think I saw this on Twitter from Daniel Pronk. So shout out to Daniel Pronk. Subscribe to his YouTube channel. You have the advertising services. Normally, the most profitable, well, when you have the most amount of revenue, is the Q4, the fourth quarter of the year. Look at this. December, this is the biggest candle here. December, high. December, very high. December, very high. And now we are in September and we are at all-time highs. Almost, no, not almost. We are at all-time highs, which means the Q4 for Amazon for this year, 2025, will smash all the past results. And it's very likely the advertising segment is very much up and to the right for the Q4. You will have a very nice candle for the next quarter. I'm not 100% sure, but pretty much sure you will have an amazing fourth quarter for advertising, because it seems like the advertising segment is picking up again. So yeah, something really important. Maybe Q4 will be very good for Amazon because of this advertising part too.
With that, I'll turn it over to Brian for a financial update.
Thanks, Andy. Starting with our top-line financial results, worldwide revenue was $180.2 billion, a 12% increase year over year, excluding a 90 basis point favorable impact of foreign exchange. In Q3, we reported worldwide operating income of $17.4 billion. This operating income includes 2 special charges, which reduced operating income by $4.3 billion.
Now you know the adjustment. We've done the work before. You know how to play with all these adjustments.
The first charge of $2.5 billion is related to a legal settlement with the Federal Trade Commission, which impacts the North America segment and is recorded in the other operating expense line. The second charge of $1.8 billion relates to severance costs for role eliminations and impacts all 3 of our segments. The severance charge is recorded primarily in the technology and infrastructure, sales and marketing, and general and administrative expense line items. Excluding these 2 charges, worldwide operating income would have been $21.7 billion, or $1.2 billion above the high end of our guidance range. Moving to our segment results. We remain encouraged by the innovation our teams are delivering for customers across all 3 segments. In the North America segment, third quarter revenue was $106.3 billion, an increase of 11% year over year. The international segment revenue was $40.9 billion, an increase of 10% year over year, excluding the impact of foreign exchange. Worldwide paid units grew 11% year over year. We continue to prioritize the inputs that matter most to our customers. In the third quarter, our sharp pricing, broad selection, and fast delivery speeds continue to resonate with customers. Customers appreciate the ability to quickly receive items essential for their daily needs, including perishable groceries, and have them delivered in the same day. Our millions of global third-party sellers continue to be important contributors to our vast selection, which helps customers find the items they need at competitive prices. We're committed to building innovative services and features for our sellers, including our ongoing advancements in generative AI. Today, more than 1.3 million sellers have used our generative AI capabilities to more quickly launch high-quality listings. Better listings translate into better traction with customers, and in Q3, worldwide third-party seller unit mix was 62%, up 200 basis points from Q3 of last year. Shifting to profitability, North America segment operating income was $4.8 billion, with an operating margin of 4.5%. Excluding the $2.5 billion charge related to the legal settlement with the FTC, North America segment operating income would have been $7.3 billion, with an operating margin of 6.9%. North America segment operating margin also includes a portion of the severance charge. International segment operating income was $1.2 billion, with an operating margin of 2.9%. Excluding the impact of the severance charge, international segment operating margins expanded year over year. Globally, our progress on...
They don't provide any details about the severance charge. They could have given us the mathematical change and the margins adjusted for this. So they give us the margins if you adjust for the settlement with the FTC, but they don't give us the margins with the severance charges, the severance charge. Okay.
Key inputs to delivering a better customer experience while driving a more efficient cost structure. For example, we're making notable strides in improving inventory placement to speed up delivery to customers. And as a result, for the third year in a row, we are on track to deliver our fastest speeds ever for Prime members in 2025. We continue to tune and improve our fulfillment operations, and our regionalized network is operating at scale. We see many benefits from our inbound process improvements, including a reduction of U.S. inbound lead time by nearly 4 days compared to last year. This allows us to be more efficient with our inventory purchasing, which benefits working capital. We're also placing inventory more strategically throughout the network. And by leveraging our existing infrastructure, we're now offering U.S. customers the ability to order perishable groceries and receive them the same day in as little as 5 hours. We're seeing positive early results. Since launching in January, when customers start shopping fresh groceries on Amazon, they are visiting the site more often and returning twice as often as non-perishable shoppers. Looking ahead, we see further opportunity to improve productivity in our global fulfillment and transportation network. We will continue to improve inventory placement to drive down distance traveled and touches per package. We will also build on the gains from our regionalized network through algorithmic improvements, as well as launching robotics and automation. While operating margin may fluctuate quarter to quarter, we have a deliberate approach to achieve sustained progress over the long term. Shifting to advertising. Advertising revenue was $17.7 billion, and growth accelerated for the third consecutive quarter. We continue to see strong growth on an increasingly large base, as our full funnel advertising approach of connecting brands with customers is resonating. Moving next to our AWS segment, revenue was $33 billion, up 20.2% year over year. This is an acceleration of 270 basis points compared to last quarter, driven by strong growth across both our AI and core services and more capacity which has come online to support customer demand. AWS revenue increased $2.1 billion quarter over quarter and now has an annualized revenue run rate of $132 billion. AWS operating income was $11.4 billion and reflects our continued growth coupled with our focus on driving efficiencies across the business. We are expanding our data center footprint, largely to accommodate Gen AI, and to the extent those assets were placed into service, the related depreciation does impact our margins. As we've long said, we expect AWS operating margins to fluctuate over time, driven in part by the level of investments we're making at any point in time.
Yes, the margins for AWS, I showed you before, are fluctuating. In the second quarter, they went down. Now they are going up. They are doing investments at the same time. So maybe you don't want the margins to go up too fast. You need to reinvest in more capacity first.
Now turning to our cash CapEx, which was $34.2 billion in Q3. We've now spent $89.9 billion so far this year. This primarily relates to AWS as we invest to support demand for AI and core services and in custom silicon like Trainium, as well as tech infrastructure to support our North America and international segments. We'll continue to make significant investments, especially in AI, as we believe it to be a massive opportunity with the potential for strong returns on invested capital over the long term. Additionally, we continue to invest in our fulfillment and transportation network to support the growth of the business, improve delivery speeds, and lower our cost to serve. These investments will support growth for many years to come. Looking ahead, we expect our full-year cash CapEx to be approximately $125 billion in 2025, and we expect that amount will increase in 2026.
Yes, as always, the CapEx is just trending up. The CapEx is infinite for Amazon, and they are just starting a new CapEx ramp-up plan. So yeah, you can expect the CapEx to grow immensely next year. Zero free cash flow will be generated.
I'll finish up my remarks with net income.
And by the way, zero free cash flow will be generated, but this is not a company that pays a dividend or that does buybacks, so it's okay. If you are doing massive capex investments, your priority is revenue. So in the next couple of quarters, we want revenue to grow immensely. Yes, you are investing a lot, but are you growing a lot? If you don't grow a lot, Amazon will be punished by public markets. So far, they are growing, so this is safe. But maybe not in the future. Maybe they will disappoint next year. So yeah, very important to check the revenue growth that is in line with this capex growth.
While we primarily focus our comments on operating income, our third quarter net income of $21.2 billion includes a pre-tax gain of $9.5 billion related to our investment in Anthropic. This investment activity is not related to Amazon's ongoing operations and is included in non-operating income. We're encouraged by the start of the peak season, and we are ready to serve customers in the coming months. I want to thank our teams across Amazon for their hard work as we get ready to delight customers during the holiday season. Our commitment to elevating the customer experience is the only reliable way to drive sustainable value for our shareholders. With that, let's move on to your questions.
Okay.
Thank you. At this time, we will now open. Our first question comes from the line of Justin Post with Bank of America. Please proceed.
Great, thank you. I'll ask on AWS. Could you just kind of go through how you're feeling about your capacity levels and how capacity constrained you are right now? And then in your prepared remarks, you mentioned Trainium 3 demand and maybe broadening out your customer base. Can you talk about the demand you're seeing, outside of your major customers for Trainium? Thank you.
Yeah, on the capacity side, we brought in quite a bit of capacity, as I mentioned in my opening comments, 3.8 gigawatts of capacity in the last year, with another gigawatt plus coming in the fourth quarter, and we expect to double our overall capacity by the end of 2027. So we're bringing in quite a bit of capacity.
Only this is extremely bullish, extremely bullish to have this level of optimism.
Today, overall in the industry, maybe the bottleneck is power. I think at some point it may move to chips, but we're bringing in quite a bit of capacity, and as fast as we're bringing it in right now, we are monetizing it. And then on the Trainium demand, outside of our major customers. So first of all, as I mentioned on Trainium 2, it's really doing well. It's fully subscribed on Trainium 2. We have, it's a multi-billion-dollar business at this point. It grew 150% quarter over quarter in revenue. And you see really big projects at scale now, like our Project Rainier that we're doing with Anthropic, where they're running they're training the next version of Claude on top of Trainium 2 on 500,000 Trainium 2 chips, going to 1 million Trainium 2 chips by the end of the year. As I mentioned, we have today with Trainium 2, we have a small number of very large customers on it. But because Trainium is 30 to 40% more price performant than other options out there, and because as customers, as they start to contemplate broader scale of their production workloads, moving to being AI focused and using inference, they badly care about price performance. And so we have a lot of demand for Trainium. Trainium 3 should preview at the end of this year with much fuller volumes coming in the beginning of 26. We have a lot of customers, both very large and I'll call it medium size, who are quite interested in Trainium 3.
Okay.
And the next question comes from the line of Brian Nowak with Morgan Stanley.
Thanks for taking my questions. Congrats on the quarter, guys. So maybe two. One, Andy, sort of a philosophical chip question. There's a lot of questions in the market about Trainium and sort of its positioning versus other third-party chips. So how do you think about the key hurdles with Trainium 3 need to overcome to really make Trainium adoption broader, to your point on the last question, and continue to drive Trainium, as opposed to satisfying what could be broader demand with third-party chips in the near term?
Yeah, well, first of all, we're always going to have multiple chip options for our customers. It's been true in every major technology building block or component that we've had in AWS. Really, in the history of AWS, it's never just one player that over a long period of time has the entire market segment and it can satisfy everybody's needs on every dimension. And so we have a very deep relationship with NVIDIA. We have for a very long time, and we will for as long as I can foresee the future. We buy a lot of NVIDIA. We are not constrained in any way in buying NVIDIA, and I expect that we'll continue to buy more NVIDIA both next year and in the future. But we're different from most technology companies in that we have our own very strong chip team, and this is our Annapurna team. And you saw it first on the CPU side with what we built with Graviton, which is about 40% better price performance than the other x86 processors. And you're seeing it again on the custom silicon on the AI side with Trainium, which is about the same amount of price performance benefit for customers relative to other GPU options. And our customers, to be able to use AI as expansively as they want, and remember, it's still relatively early days at this point, they're going to need better price performance, and they care about it deeply. And so, I mentioned earlier the momentum that Trainium 2 has, and I think that for us, as we think about Trainium 3, I expect Trainium 3 will be about 40% better than Trainium 2, and Trainium 2 is already very advantaged on price performance. So we have to, of course, deliver the chip. We have to deliver it in volumes and deliver it quickly, and we have to continue to work on the software ecosystem, which gets better all the time. And as we have more proof points like we have with Project Rainier, with what Anthropic is doing on Trainium 2, it builds increasing credibility for Trainium, and I think customers are very bullish about it, and I'm bullish about it as well.
Great comments.
And our next question comes from the line of Doug Anmuth with JP Morgan. Please proceed with your question.
Thanks for taking the question. I'll stick with basically the same topic, Andy. But can you just talk a little bit about the architecture of Project Rainier and how it's differentiated, and what that means for customers and for AWS? And do you expect Rainier to expand beyond Anthropic? And how do you replicate Rainier with Trainium 3 chips? Thank you.
Yeah, I think what is compelling for Anthropic around Project Rainier is really is the Trainium 2 chip, which we built first of all, we built a very large cluster that they can use in a very expansive way, and it's not simple to be able to build a cluster that has 500,000 plus chips going to 1 million. That's an infrastructure feat that's hard to do at scale. And so, some piece of it is the infrastructure capabilities that we built over a long period of time in AWS that is, unusual in the industry. But it's just also the performance of the chip and the price performance, which both of which matter. And I think that Project Rainier is something that is specific for Anthropic, but we have a lot of other customers who are interested in employing large clusters of Trainium chips that we're going to hopefully give them a chance to do so with Trainium 3.
As I told you before, if they are collaborating, working with Anthropic a lot, the value of Anthropic will go up. So they have all the incentives to work closely with Anthropic because Amazon owns ownership, 14%, something like this, in Anthropic. So if Anthropic is valued highly, the net income of Amazon will go up. They have all the incentives you need to work closely with them and to help Anthropic as much as possible. It creates a beautiful flywheel, a virtuous cycle for Amazon.
And the next question comes from the line of Mark Mahaney with Evercore ISI. Please proceed with your question.
Thanks. I want to ask about two topics, groceries and then how to think about headcount in the future. And on groceries, the perishables, I think last quarter you talked about 70% or something of users had never purchased from perishables from Amazon before. Just talk about whether I think you used the term game changer before. Does this mean that maybe you no longer need to do Amazon Fresh stores? You always had this DVD, delivery van density advantage. And have you kind of reached a point, you think, of scale and speed that you really can change people's habits and really have them consider Amazon as one of their first grocery options? Do you really feel like you're at that point? And then secondly, just on the headcount, given some of the recent news, just talk to us about how you think about headcount going forward. Are you seeing is the level of efficiencies that you're getting from AI such that you can keep headcount relatively flattish for the foreseeable future? Just talk about the pros and cons or the wins and losses in terms of that headcount going forward. Thank you.
Great question.
Yeah, so I'll start with grocery, Mark. We have a very large grocery business. If you look at our entire grocery business, if I don't even count Whole Foods Market and Fresh, in the last 12 months, it's over $100 billion of gross merchandising sales, which would make us a top 3 grocery in the U.S. A good chunk of it is a lot of the items that you find in the middle aisles, so consumables and canned goods and pet food and health and beauty. Very significant, that continues to grow at a very good clip. But then, we also have Whole Foods Market, which is the pioneer in organic foods, which is also growing at a faster clip than most grocery companies and with an attractive trajectory on profitability. And we'll expand our Whole Foods physical presence over the coming years here. And I'm also very excited about this new concept, Daily Shop, that we have, which is a smaller version of Whole Foods in urban settings, which we have 3 that we've launched. They're off to very good starts that you should expect to see more of as well. And we have always been, as you referenced, we've talked a lot about having a larger mass physical presence. And we continue to experiment with various formats. But the one that we are most excited about is what you referenced, which is the ability to provide perishable groceries with same-day deliveries. And if you think about how many of our customers are buying from us multiple times a week and who are buying things like shampoo or detergent or paper cups or water, where the ability to add milk and eggs and yogurt, and other perishables to their order and have it live in the same shopping cart and then show up a few hours later is very compelling. And we started with a few markets about a year ago, and we were really taken aback at the adoption, not just the number of people that started buying perishables from us very quickly, but how often they came back downstream to buy perishables and groceries from us in the future. And so we've now expanded that to 1,000 cities around the U.S. We'll be in 2,300 by the end of the year, and it's really changing the trajectory and the size of our grocery business. And I also believe that this many years tradition of the weekly stock-up, grocery stock-up is changing, and I think we're a big part of that, and I think there's a lot of potential there for the grocery side. It doesn't mean that we won't continue to experiment with other physical formats, but we're on to something very significant with what we're doing with perishables from our same-day facilities. And then on your headcount question, what I would tell you is, the announcement that we made a few days ago was not really financially driven, and it's not even really AI driven. Not right now, at least. It's culture. And if you grow as fast as we did for several years, the size of businesses, the number of people, the number of locations, the types of businesses you're in, you end up with a lot more people than what you had before, and you end up with a lot more layers. And when that happens, sometimes without realizing it, you can weaken the ownership of the people that you have who are doing the actual work and who own most of the two-way door decisions, the ones that should be made quickly and right at the front line, and it can lead to slowing you down. And as a leadership team, we are committed to operating like the world's largest startup, and that means removing layers, it means increasing the amount of ownership that people have, and it means inventing and moving quickly. And I don't know if there's ever been a time in the history of Amazon or maybe business in general with the technology transformation happening right now, where it's important to be lean, it's important to be flat, and it's important to move fast, and that's what we're going to do.
This is extremely bullish. This comment, this answer, is extremely bullish for Amazon. They don't want to hire many people. You can expect the headcount to stay flat in the future. They will replace humans with robots, and actually that's very true. If you look at the report from insiders, employees, they say 10 years ago, you were a few phone calls away from Jeff Bezos. You had a few layers, but that's fine. Now, this has become such a juggernaut, such a big company. You have many layers and you have bureaucracy. And actually, this is working and this will work because we have seen the exact same phenomenon for Meta platforms in 2023, the year of efficiency. You had a public letter from Mark Zuckerberg saying exactly this. We have become too big, too bureaucratic, so we want to be leaner with smaller teams. If you don't believe me, go on the internet, find the Meta platforms letter, the year of efficiency. Word for word, they are saying the same thing. And for Meta platforms, it has worked. They have reduced the headcount, focused on margins, and it is working beautifully. So yeah, I like what they are doing. They are focused on efficiency, being lean, being small, and being fast. This is very hard to do because Amazon is the second biggest employer in the United States. But yeah, pretty important to be lean and not fall into this bureaucratic environment. This is how big companies die. If you have too many employees, you have too many layers of management teams, this is how you can become inefficient and how big, huge companies die. So Amazon doesn't want to die. Amazon wants to continue to grow. So they are doing this. This is extremely bullish and you can expect more redeployment of resources in the future.
And the next question comes from the line of Eric Sheridan with Goldman Sachs. Please proceed with your question.
Thanks so much for taking the question. Wanted to know, Andy, if you could reflect on the opportunity that's continuing to present itself in terms of rolling out more robotics and automation and the broader theme of physical AI across your operations, and how you should be thinking about that as a driver of potential efficiencies, but also as a driver of the ability to possibly reinvest back in the business over the long term. Thanks so much.
Robotics is a very substantial area of investment for us. We have over 1 million robots in our fulfillment network at this point. And I would say that while that's significant, we have a lot of invention in flight. So I expect that we'll have more over a period of time. Robotics are very important for us and for our customers and for our teammates because they improve safety,
They boost productivity, they increase speed, and they let our human teammates focus on problem solving and what they do best. And we expect that our people will remain at the heart and the center of our fulfillment network, as they have from when we first started working on robotics. And we expect that over time we will have a fulfillment network where robots and humans complement each other and work together. But I think you're going to continue to see us invest very significantly in robotics. It's going to help on the safety, the productivity, the speed, and ultimately some of the cost pieces, which will allow us to continue to improve the customer experience.
Okay.
And the next question comes from the line of John Blackledge with TD Cowen. Please proceed with your question.
Great. Thank you. How does Amazon think about agentic commerce going forward, and how do you think Amazon will serve customers using agents to purchase goods on Amazon in the future? Thank you.
I'm very excited about, and as a business, we're very excited about in the long term the prospect of agentic commerce, and it has a chance to be good for customers. It has a chance to be really good for e-commerce. And I think if you know what you want to buy, there are a few experiences that are better than coming to Amazon. But if you don't know what you want, it's a physical store with a physical salesperson still has some advantages. Obviously, lots of people do it on Amazon all the time, but you very often want to ask questions and get help narrowing what you're going to look for. And as you keep asking new questions, having a whole bunch of different options presented to you. And I think AI and agentic commerce are going to change the experience online, where that experience where you're narrowing what you want when you don't know is going to get better online than it even is in physical environments. Now, we obviously have our own efforts here in agentic commerce. We have Rufus, which I talked about in my opening comments, which is continuing to get better and better and used more broadly. And we have features like Buy For Me, where we will surface on Amazon even items that we don't stock that other merchants have. And then if customers want us to go and buy it for them on those merchants' websites, we will do that. And both of those have been successful for us. But we're also having conversations with and expect over time to partner with third-party agents. And I think that it reminds me in some ways of the beginning of search engines many years ago being sources of discovery for commerce. And you had to kind of figure out the right way to work together. And today, search engines are a very small part of our referral traffic, and third-party agents are a very small subset of that. But I do think that we will find ways to partner. We have to find a way, though, that makes the customer experience good. Right now, I would say the customer experience is not good. There's no personalization. There's no shopping history. The delivery estimates are frequently wrong. The prices are often wrong. So we've got to find a way to make the customer experience better and have the right exchange of value. But I do think that the exciting part of this and the promise is that AI and agentic commerce solutions are going to expand the amount of shopping that happens online. And I think that's really good for customers, and I think it's really good for Amazon, because at the end of the day, you're going to buy from the outfit that allows you to have the broadest selection, great value, and continues to deliver for you very quickly and reliably. And I think that bodes well for us.
And our final question comes from the line of Colin Sebastian with Baird. Please proceed with your question.
Thanks. Good afternoon. I guess first on AWS, following up there, how much of this acceleration is driven by core infrastructure versus AI workload monetization? And I think part of it is trying to understand how important newer services like Agent Core are becoming in bringing enterprises to AWS to build agents. And then I guess secondly, regarding the acceleration in advertising, if you could potentially disaggregate the core advertising contribution versus DSP and Prime Video, that would be helpful as well. Thank you.
Yeah, I'll start on the AWS side. We are seeing, we're really pleased with the results from this quarter. 20% year over year on a annualized run rate of $132 billion is unusual. And we have momentum. You can see it. And we see the growth in, both our AI area, where we see it in inference, we see it in training, we see it in the use of our Trainium custom silicon. Bedrock continues to grow really quickly. SageMaker continues to grow quickly. And, I think that the number of companies who are working on building agents is very significant. I do believe that a lot of the value that companies will realize over time in AI will come from agents. And I think that building agents today is still harder than it should be. You need tools to make it easier, which is why we built Strands, which is an open source capability that lets people build agents from any model that they can imagine. But even more so, when you talk to enterprises or companies that care a lot about security and scale, they're starting to build agents, and they don't really feel like they've had building blocks that allow them to have the type of secure, scalable agents that they need to bet their businesses and their customer experiences and their data on. And that was really the inspiration behind Agent Core, was to build another set of primitive building blocks like we built in the early days of AWS, where it was compute and storage and database. We defined a set of building blocks that you needed to be able to deploy agents securely and scalably that we provide in Agent Core. And then when we talk to our customers, it really resonates. There is not anything else like it. It's changing their time frame and their receptivity to building agents. And it's very compelling for them. So I do think, the combination of what we're doing to enable agents to be built and run securely and scalably, as well as some of the agents that we're building ourselves that our customers are excited about, are compelling for them. And
they are not going to talk about the AWS problem when the servers stopped for a few hours and half of the world was shut down. Nobody's going to ask them what happened. And they talk about reliability, right? Well, as a reliable system, you don't want these kind of problems. And it happened a few days ago. Nobody's going to ask them about this. Okay.
I think the other place we see a lot of growth in AWS also, is just the number of enterprises who've gotten back to moving from on-premises infrastructure to the cloud. And we continue to earn the lion's share of those transformations. And, I look at the momentum we have right now, and I believe that we can continue to grow at a clip like this for a while. I think on the...
Okay, bullish. This is bullish. They continue to grow like this for a while. If they can continue to grow at 20% per year and grow from there 25% per year, extremely bullish.
Advertising side, that is also an area where I think collectively we feel very pleased about the progress. Every single one of our advertising offerings this quarter grew in a meaningful way. I think there's a few things going on for us. We have what I think of as a pretty unusual full funnel offering. And if you look at the top of the funnel, which typically tends to be awareness building and broad scale, to be able to use our own Prime Video and our live sports capabilities, as well as going all the way down to the bottom of the funnel at point of sale, being able to use sponsored products. That's, most people don't have a full funnel offering as robust as that. And then when you layer on top of it the combination of the audience curation and development we can do, along with the advantage measurement, it just all leads to a return on advertising spend that's very unusual. And I think there are multiple places where we can expect to continue to grow. One is in our stores business. I still think, if you look at the worldwide market segment share of retail, still 80 to 85% of it lives in physical stores. And that equation is going to flip over time. And I think AI is going to only accelerate that. So I think we have an opportunity, a significant opportunity still in our existing stores. And then I think video, we've only been at this for a little bit of time, but it's already a very large amount of advertising revenue, and we're still relatively early stage. I think that will continue to be a big area of growth. And then as you reference, the amount, their demand side platform, or Amazon DSP, that is growing really quickly as well. Some of it had to do with the fact that we had some features. We always had a number of the core components people wanted around some of our properties, the measurement capabilities, Amazon Marketing Cloud, but we lacked some features for a while as we were building out our DSP that customers told us mattered. And the team over the last 20 months have closed those gaps in a very significant way, so that now people feel like our DSP is fully featured. And then you look at some of the partnerships that we've done. The Roku partnership gives us the largest connected TV footprint in the U.S., and you layer on top of that what we've recently done in providing our DSP customers the opportunity to integrate with the ad inventory in Netflix and Spotify and SiriusXM. It's powerful, and so we are growing very quickly on the demand side platform. So very optimistic about what we're doing there. We have continued work to do, obviously, but I don't think we're close to being able to grow there.
Thanks for joining us on the call today and for your questions. A replay will be available. We appreciate your interest in Amazon. And
this is the end. No closing remarks, just Q&A. Okay, a lot of bullishness from the call. The tone is positive. You didn't have long answers with no meaning, too technical. a little bit technical when it comes to groceries, but that's fine. They clearly tell us investors that AWS is growing, the advertising segment is growing, you expect more margins in the future, you expect more capex, and you expect to continue to grow at this rapid pace. So that's a lot of bullishness, and I look forward to seeing the next earnings calls for this one, how the AWS segment is growing for next year. So that's it. I think you know everything about this quarter right now. Take into account the adjustments, take into account the tone of the management, but so far it's very positive. So maybe you will have a catch-up effect at the end of 2025, meaning the stock of Amazon may go up meaningfully. The sentiment can change a lot. As you can see from the pre-market level, the stock is up plus 12%. We have seen the same phenomenon for Alphabet, Google a couple of months ago. People said Google was dead, and then you revert back, you reaccelerate, and the stock went up and up and up and up. So maybe this is the change in sentiment for Amazon, because now growth is back, the optimism is back. So really looking forward to seeing how the stock will react at the end of 2025. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.